Hi everyone, I'm Dr. Nagalakshmi, Assistant Professor, Department of Commerce with Finance and Dr. SNS Rajalakshmi College of Arts and Science, Autonomous, Coimbatore. Today we are going to see the continuation of the financial planning, that is the unit financial planning. In that we are going to see the topics risk profiling, asset allocation, contingency fund and investors guide to the mutual, that is guide to financial planning. Now we are into the subject. First, we should know what is meant by risk profiling. Risk profiling means why it is important. First, risk profiling determines how much risk an investor can take. That is the very important thing. So, why important? Wrong risk assessment can lead to stress or loss. It's obviously it is right. So, what are the things to be considered? That is, factors to be considered. And what are the factors affecting risk? That is, age, job stability. Next is number of dependents in our family, health condition, financial knowledge. These are the factors that affects the risk. So here we should know what are all the types of investors there in making the investment. There will be a conservative investor, there will be a moderate investor, and there will be an aggressive investor. Conservative, the word itself gives an idea that he wants safety. He does not want to take high risk. So he invests in bank, FDs, he invests in debt funds. He is said to be a conservative investor. Moderate investor, that is mix of growth and safety. So that is 50-50. 50% in equity, 50% in debt fund. So investment in balanced or hybrid funds. Aggressive, the person who is ready to take any risk in order to earn high returns. So high growth, high risk concept. Focus on high growth, investment in equities, sectoral funds. These are said to be the types of investors. Next, what we are going to see is the asset allocation. So, as we know, what is meant by asset allocation? How much asset in what investment at what rate? It is said to be asset allocation. Now we are going to see asset allocation helps diversify investments. So asset allocation help us to diversify our investment in order to reduce the risk. That is, splitting investment into different categories for balance between risk and return is said to be asset allocation. Why it is needed? Because don't put all your eggs in one basket. If anything happens, all the eggs will get broken and it will be wasted. So it is the right example for asset allocation. Now we are going to see the types of asset allocation. That is strategic, that is long term, that is fixed long term ratios. That is 60% in equity, 30% in debt and 10% in gold is said to be strategic. Tactical, that is short term and based on market changes. Short term and based on market changes, that is adjusted based on market conditions. Increasing equity allocation when market are low. So this is strategy to be followed. So there is, they have given some example for the asset allocation for different age. If it is 25 years old, 70% in equity, 20% in debt and 10% in gold. If it is 45 years old person, 40% equity, 50% debt and 10% in gold. If the person is if he is a retired person, 10% in equity, 70% in debt and 20% in gold. So it's an example, but it's a right portfolio how that is we should follow in order to make our investment to get higher returns at different ages. Now we are going to see contingency fund. What is meant by contingency fund? We know contingency means in order to meet the unexpected situations. That is emergency fund. So contingency fund means an emergency fund acts as a financial cushion for our life. So reserve money for unforeseen situations is said to be contingency or emergency fund. So it is idle, that is 3 to 6 months of living expenses, it is okay. Where to keep this fund? It can be kept as a liquid, that is in savings account, liquid mutual funds or short term FDs we can make the investment. They have given an example. If a family spends 40,000 rupees per month, emergency fund needed is 2 to 2.5 lakhs per annum. It is said to be emergency fund. This is how we have to allocate the fund for emergency situations. Next we are going to see is what is Investor's Guide to Financial Planning. Investor's Guide means here investors has to follow while making the financial planning. So they have given some guidance. Start early. Say if you get a job at the age of 18 or at the age of 21 after completing your undergraduation, immediately you have to start investing. Start early. That is power of compounding. 5,000 invested at the age of 25 years grows more than 10,000 at 35 years. So what they are telling us, they are giving us some some advices. How we have to make the investment? We have to diversify. How we have to diversify? Mix of equity, debt and gold. I have given you in the that is in here we have seen, that is at the asset allocation we have seen. So at these type of ages, how much to be invested in equity, how much to be invested in debt and how much to be invested in gold. That is what here, diversify, mix equity, debt and gold. So review regularly. If you make an investment, you should not leave as it is. We have to make a review regularly how our investment is, whether it is gaining, whether it involves any risk, is there any changes. Okay, so adjust to salary hikes. If I get an increment of 5,000 rupees, I can plan not for for making expenses. I have to plan for making further investment. Inflation, lifestyle changes. So these will be some criteria, so that we have to make our review regularly. Avoid emotions. Don't panic during market crash. We have to make a step in order to take experts' help. Advisors gives clarity picture about this, about financial planning. So I think you got some idea in making the financial planning. So thank you so much for the patience listening.